Accrued expenses and prepaid expenses are two sides of the same accounting concept, timing. One is recorded before it's paid, another one is paid before it's used. Both adjust expenses to the correct accounting period, just from opposite directions. In this lecture, we are looking at accruals, also called accrued expenses. Accruals arise when a business has used a service but has not yet received the invoice or made the payment. Typical examples of accrued expenses include utilities used but not yet billed, staff bonuses earned but unpaid, and audit or professional fees. In all these cases, the business has already benefited from the service. Accruals affect all three financial statements, but in different ways. On the profit and loss, the expense is recognized in the period it is incurred. On the balance sheet, the accrual is shown as a liability. On the cash flow statement, there is no impact until the cash is actually paid. So, an accrual is an expense incurred in the current period, but not yet invoiced or paid. Accounting rules require us to recognize the expense now, even though the cash will be paid later. Let's look at an example. A utility bill for December 2025 is received in January 2026. The cost incurred for December is £1,200. Step 1 is to ask, does this cost belong in December's profit and loss? The answer is yes, because the utilities were used in December. Even though no invoice was received, we must recognise the expense. In December, we debit utility expense £1,200 in the profit and loss and credit accrued expense on the balance sheet. This shows that we have recognised the cost and recorded a liability. In January, when the supplier invoice arrives, we now have an official document. There is no profit and loss impact in January 2026 because the expense was already recognised in December. Instead, we reverse the accrual and replace it with a normal supplier balance in trade payables. Journal, when the invoice is received, debit accrued expense £1,200. This removes the accrual liability and credit trade payables £1,200. It moves the liability from accrued expense to trade payables. January P&L impact is £0. Next, when we pay the supplier, we clear the trade payables and reduce the bank balance. Journal when the bill is paid. Debit trade payables £1,200, payable goes down to £0, and credit bank £1,200. Money leaves the bank. What changes now? Bank decreases by £1,200. Trade payables decreases by £1,200. Now let's look at a professional fee covering January, February and March 2025. The total cost is £900 and the invoice is received in April. The cost is spread evenly over 3 months, so £300 per month is incurred. In each month, we recognise £300 in the profit and loss and increase the accrued expense on the balance sheet. Let's look at January. The service is used in January, no invoice received yet. Because the cost relates to January, it must be recognised in January's accounts. We debit professional fees in the P&L and credit accrued expense in the balance sheet. No impact on the cash flow in January. The service continues in February. Still no invoice received. February professional fee cost must be recognised in the P&L and balance sheet. Cumulative balance sheet accrued expense now totals £600. No cash flow impact yet. March is the final month of the service. Invoice is still not received. The final portion of the cost is recognised. Journal entry is debit professional fees in the P&L and credit accrued expense in the balance sheet. Cumulative balance in accrued expense balance sheet is £900. No cash flow impact yet. In April, invoice for £900 is received and paid. There is no expense recognised in April because the cost was already recognised in earlier months. The accrued expense in the balance sheet is cleared when the invoice is received. Cash flow is £900 cash outflow as the invoice was paid. Let's now walk through this example month by month using the table. At the top, we have professional cost in the profit and loss. In January 2025, we recognise an expense of £300 because the service was used in January. The same happens in February and March. Each month we recognise £300. You'll notice that April shows no expense because no service was provided in April. Now let's look at the accrued expense, which is a liability on the balance sheet. In January, the accrued expense is £300. In February, it increases to £600 because another month of cost has been incurred. In March, it increases again to £900, which represents the total amount owed. In April, the accrued expense balance goes back to zero because the invoice is received. Looking at the bank account, there is no cash movement in January, February and March. Cash only leaves the business in April when £900 is paid. This shows clearly that cash flow timing is different from expense recognition. When the invoice is received in April, the accrued expense is cleared and replaced with a trade payable. Once the invoice is paid, the trade payable balance returns to zero. This example demonstrates the accruals principle. Expenses are recognised when they are incurred, not when they are paid. The profit and loss reflects the correct monthly cost. The balance sheet shows what is owed at each point in time, and the cash flow statement reflects only actual cash payments. Prepaid expenses are expenses paid in advance. This means expenses are paid first, but the benefit is received later. In accounting, we do not always recognise expenses immediately when they are paid. Expenses are recognised when they are used or incurred, meaning when the benefit is received, not when they are paid. This is because of the accruals concept. The accruals concept tells us to match expenses to the period they relate to, not the period when they are paid. Examples include rent paid before using a building, insurance paid before cover starts, and software subscriptions paid in advance. Let's look at where a prepayment appears in the accounts. A single prepayment affects 3 different areas, but not all at the same time. First, let's look at cash flow. Cash is recorded if and when cash is paid. Sometimes a business pays up front. Sometimes it receives an invoice and pays later. Either way, cash flow only cares about the actual movement of cash. If no cash has been paid yet, nothing appears in cash flow. Now let's look at the profit and loss account. The profit and loss does not show when cash is paid. It shows only the portion of the expense that is used or incurred during the period. For prepayments, that means we spread the cost over the months that receive the benefit. Each accounting period shows its own expense only. Finally, we look at the balance sheet. Any part of the expense that has been paid for but not yet used is shown here. This is called prepaid expenses and it is a current asset. It represents a future economic benefit. The balance sheet shows what is left unused at the reporting date. Let's look at an example to see how this works in practice. The business pays rent on the 1st of December 2024. The amount paid is £12,000. This payment covers the period from the 1st of January 2025 to the 31st of December 2025, which is a total of 12 months. If we divide £12,000 by 12 months, the cost is £1,000 per month. Now, let's think carefully about 2024. In December 2024, the cash is paid, but no rent is actually used in that year. The building is only used from January 2025 onwards. So, in the 2024 accounts, the profit and loss account shows no rent expense because no benefit has been received. The balance sheet shows a prepayment of £12,000. This £12,000 is treated as an asset because it represents a future economic benefit that the business will use in 2025. Now we move into January 2025. In January, The business uses 1 month of rent. That 1 month costs £1,000. From an accounting point of view, this means two things happen. First, in the profit and loss account, we recognise a rent expense of £1,000 because that is the amount of benefit used during January. Second, in the balance sheet, the prepayment is reduced. It started at £12,000 and after using 1 month, it reduces to £11,000. A simple way to think about this is that we are moving £1,000 from the balance sheet into the profit and loss account. In February 2025, exactly the same process happens again. The business uses another month of rent, which again costs £1,000. So in February, the profit and loss account shows a rent expense of £1,000. The prepaid expense in the balance sheet reduces from £11,000 to £10,000. It is very important to remember that February's profit and loss shows £1,000 only. It does not show January plus February. Each month stands on its own. In March 2025, once again, 1 month of rent is used, so the profit and loss account shows another £1,000 rent expense. The prepayment reduces further to £9,000. Each month follows the same logic. The profit and loss account shows the expense for that month only. The balance sheet shows what is still unused. This same pattern continues every month until December 2025. Each month, £1,000 is charged to the profit and loss account. The prepaid expense account in the balance sheet reduces by £1,000 each month. By the end of December 2025, the total rent expense recognised in the profit and loss account is £12,000. The prepaid expense account in the balance sheet is £0 because the full benefit has now been used. Let's recap the key points about prepayments. Prepaid expenses are expenses paid in advance. They are shown as current assets in the balance sheet. Cash is recorded when it is paid. If an invoice is received for a future period but has not yet been paid, there is no cash movement yet. Expenses are recorded when they are used or incurred. The profit and loss account shows the expense for the period. The balance sheet shows what remains unused. So far, we've looked at prepayments from the cash-first perspective, rent paid in advance from the bank. Now, we are going to look at the other very common business situation when we receive an invoice first and pay it later. This means we must deal with accounts payable, but the prepayment logic stays exactly the same. Here is our insurance scenario. We receive an insurance invoice in January 2025 for £9,600. The insurance covers period from the 20th of January 2025 to the 19th of January 2026, a full 12 months. The invoice is not paid until February, so we have accounts payable is involved. Let's deal with January first. 3 things matter in accounting: when the invoice is received, when the cash is paid, and when the benefit is consumed. In January we have the invoice. We have not paid in January. We have only used part of the insurance. Because the insurance does not start on the first of the month, we cannot simply divide by 12. We must apportion by days, not months. Excel helps us do this accurately and consistently. We first calculate the total days of cover. Then we calculate a daily insurance rate. Finally, we calculate how many days were actually used up to 31st January. Total cover days is 365. Daily rate is £9,600 divided by 365. Days used in January are 12. January expense equals £315.62. Now we translate those calculations into accounting entries. Insurance expense in January's profit and loss is only £315.62. The remaining £9,284.38 prepayment in the balance sheet represents future economic benefit. Because the invoice is unpaid, The full £9,600 sits as a liability in accounts payable. Notice, we have both a prepayment and a payable at the same time. Now let's move to February. Two separate things happen in February. We pay the invoice and we consume more insurance. Paying the invoice only affects accounts payable and bank. It does not affect profit. The February insurance expense comes from the same daily rate calculation, 28 days multiplied by daily rate. £736.44 is the February insurance expense that appears in the profit and loss. This expense is recognised whether or not the invoice has been paid. This reinforces the accrual principle. The prepayment balance is simply the opening prepayment minus January expense and minus February expense. £8,547.94 is the balance sheet figure at the end of February. March works exactly the same way. The only thing that changes is the number of days in the month. March runs from the 1st of March to the 31st of March. The insurance is active for the entire month, so we use 31 days of insurance in March. Again, we are focusing on usage, not payment. We already know the daily rate, £9,600 divided by 365 days. Daily rate multiplied by 31 days gives us £815.34. The daily rate stays the same, only the number of days covered changes. That's why March looks different from February and January. In March, we record £815.34 as insurance expense in the profit and loss. This represents only the insurance used in March. That leaves us with £7,732.60 as a prepayment at the end of March. This prepayment balance represents future insurance cover. Now let's look at the whole year 2025. Only the insurance used in 2025 appears in the profit and loss, not the full invoice. In the balance sheet at 31st of December 2025, one part of the insurance still relates to January 2026, so a prepayment remains. This reinforces the matching principle. To summarise it, profit and loss shows only what is used. Prepaid expenses show future benefit. These are different perspectives, and accounting works because we keep them separate. Understanding prepaid and accrued expenses ensures expenses are recorded in the correct period, giving a true and fair view of financial performance. An accrued expense is an expense that has been incurred but not yet paid. A prepaid expense is a payment made in advance for a benefit that will be received in a future accounting period.